Every spring, Marcus gets a tax refund of about $3,000. And every spring it feels like a win, a little windfall from the government. He's already planning what to do with it. What Marcus doesn't realize is that the refund isn't a gift. It's his own money, handed back to him with no interest, after the government held it for a year. And that refund is just the visible tip of a much bigger leak, one that quietly costs people like him far more than $3,000 every year, without them ever seeing it. Let's follow Marcus through one tax year and find the leak. Start with that refund, because it reveals the first misunderstanding. A refund doesn't mean you beat the system. It means you overpaid all year. Every paycheck, more was withheld than Marcus actually owed, so he loaned the government money interest-free for 12 months, and they returned it in spring with a thank you note. If he had adjusted his withholding to keep that money in his own account, he could have invested it, paid down debt, or earned interest on it all year. Instead, it sat in Washington doing nothing for him. So the refund he celebrates is really a receipt for a year-long mistake. But that's the small leak. The bigger one starts with a number almost everyone gets wrong: their tax rate. Ask Marcus what bracket he's in, and he'll say 22%, and he believes 22% of every dollar he earns goes to taxes. It doesn't. That's his marginal rate, the rate on his last dollar earned, not his whole income. His actual effective rate, what he really pays across all his income, is far lower, because the early chunks of his income are taxed at much lower rates first. Marcus has been overestimating what he pays and underestimating what he controls. And that single confusion is why he never bothers to do the one thing that would actually cut his bill. Here's the part that changes everything, and it's the opposite of what most people assume. You don't lower your tax bill by earning less or by finding shady loopholes. You lower it by choosing where your money lands before it's ever taxed. The tax code is not one flat wall. It's full of doors the system leaves open on purpose, and walking through them is completely legal. In fact, it's exactly what the rules are designed to encourage. When Marcus puts money into a retirement account like a 401k or an IRA, that money comes out of his taxable income before the tax is calculated. So a dollar he saves for his future is a dollar the government never taxes that year. The same is true of a health savings account, which may be the most tax-advantaged account in existence. Money goes in untaxed, grows untaxed, and comes out untaxed for medical costs. Marcus has access to all of these through his job. He's just never used them, because he assumed taxes were a fixed bill he had no control over. So year after year, he hands over money he was never actually required to pay. And the cost of that compounds in a way that's easy to miss. Every dollar Marcus could have shielded and invested isn't just a dollar of tax saved today. It's a dollar that could have grown for decades. The leak isn't the tax itself. Taxes fund the roads and schools we all use. And that's the deal. The leak is the gap between what Marcus is legally required to pay and what he actually pays because he never learned the levers. For a typical earner, that gap can quietly add up to tens of thousands of dollars over a working life. And there's one open door so valuable, it's almost insulting to walk past. Yet most people do. The employer match. Many jobs will match the money you put into your 401k, dollar for dollar, up to a limit. Read that again. If Marcus contributes and his employer matches, that's an instant, guaranteed, 100% return on his money before it's invested in anything at all. There's no stock, no crypto, no side hustle on earth that reliably doubles your money the moment you commit it. And it's sitting right there in his benefits package, untouched, because he never filled out the form. Every year he skips it, he turns down a raise he already earned. Picture two co-workers, Marcus and a colleague named Dana, hired the same day, same salary, same desk. Dana contributes just enough to capture the full match and lets it sit in a simple index fund. Marcus doesn't, because that money feels better in his checking account today. For the first year, the difference is invisible. A few $1,000s Dana simply didn't spend. But that gap compounds. Her contributions, plus the free match, plus decades of growth, none of it taxed until retirement. 30 years later, Dana isn't a little ahead. She's hundreds of thousands of dollars ahead, on the exact same paycheck, because of one decision Marcus found mildly inconvenient on his first day. They earned identical amounts. One of them just stopped leaving money on the table. And the match is just the most obvious door. There are others most people never open. A health savings account that's triple tax-free, a Roth that grows completely untaxed for decades, even a credit designed to pay lower earners for saving that almost no one claims. Each one is a lever the code hands you on purpose. That's the quiet, uncomfortable truth under the whole system. It rewards the people who read the fine print and gently penalizes the people who don't. So slowly, the penalty never feels like an event. There's no alarm, no late notice, no single moment where Marcus realizes what it cost him. There's just a number, decades later, that's smaller than it could have been. And here's what makes it sting. The system isn't hiding any of this. The match is in his handbook. The accounts are one click away in his payroll portal. The withholding takes 5 minutes to change. None of it is secret or complicated or reserved for the wealthy. The only thing between Marcus and thousands of extra dollars a year is the gap between knowing and doing, the most expensive gap in personal finance. Which raises the only question that actually matters. So what should Marcus actually do, starting with his very next paycheck? 3 moves, none of them complicated. First, fix the withholding. A giant refund isn't a prize. Adjust it so his own money stays in his account during the year, where it can work for him instead of for the Treasury. Second, use the doors that are already open. Contribute to the tax-advantaged accounts his job offers, even a small amount, so income lands somewhere it isn't taxed before it ever hits his bracket. Third, learn the difference between his marginal and effective rate, so he stops fearing a number that was never true and starts making decisions based on what he actually pays. None of this is about dodging taxes or finding a secret trick. It's about understanding that the tax system runs on autopilot, and the default setting was never designed to be optimal for you. It was designed to be simple to collect. The people who keep more of their money aren't earning a special privilege. They simply read the manual everyone else skipped. Remember Marcus, celebrating his $3,000 refund? By the end of the year, the version of him who fixed his withholding and used the open doors didn't get an exciting check in the spring, and he was thousands of dollars ahead, with that money growing in his own accounts the entire time. The boring choice quietly won. That's almost always how money works. The flashy moment costs you, and the unglamorous habit pays. If this made the invisible visible, subscribe. Every week we run the math nobody runs for you. This is educational, not financial advice. Now go read the manual.